Walk through most major airports and you'll see two completely different versions of air travel. Outside, fluorescent lights, crowded gates, expensive sandwiches, and a desperate search for an outlet. Inside the lounge, comfortable chairs, Wi-Fi, drinks, and food that appears to be free. But none of it is free. Someone paid for that food, rented the space, and hired the staff. And at an airport, basically every square foot costs a fortune. So why are airlines, banks, and credit card companies racing to give travelers more lounges? Because here's the weird part. The chair and the buffet aren't really the product. The lounge is a machine for selling loyalty, and that can be worth far more than the cost of your snack. The airport lounge started as an actual invitation-only club. In 1939, American Airlines opened what it describes as the first airport lounge at New York's LaGuardia Airport. You couldn't simply buy your way in. Membership was offered to important customers, celebrities, dignitaries, and other people the airline wanted to keep close. And right there, you can see what lounges were built to do. They separated a small group of valuable passengers from everyone else and made those passengers feel recognized. As commercial flying grew, other airlines developed their own clubs. Access increasingly came through a first-class ticket, frequent flyer status, or a paid airline membership. The thinking was pretty simple. Frequent business travelers were incredibly valuable. Make the time before their flight feel better, and maybe they'd choose your airline again next week. The lounge didn't need to make its money one cocktail at a time. It was protecting a much bigger relationship. For decades, lounges were closely tied to one airline. Then, somebody found a way to crack the doors open. Priority Pass launched in 1992 after its founders saw premium passengers escaping the terminal while everyone else waited outside. Instead of building an airline, it built a network. Independent lounges and participating airline lounges could accept members. Travelers could buy access without committing to one carrier. And banks could add that access to a credit card. Today, Priority Pass advertises more than 1,900 lounges and airport experiences around the world. Importantly, it does not operate all of those lounges. It connects members with lounge partners that run them. And that changed everything. Lounge access became something you could bundle, distribute, and sell on a massive scale. The same lounge could serve a business class passenger, a traveler with a direct membership, someone paying for a one-time visit, and a cardholder whose bank arranged access. One room, several ways to get paid. There is no single airport lounge business model. An airline lounge can be funded by premium tickets, elite status economics, annual memberships, day passes, and co-branded credit cards. An independent lounge can sell entry directly, contract with airlines that need a lounge for premium passengers, or join an access network. The traveler may pay at the door. An airline may pay under a contract, or a membership and card partner may cover the visit under negotiated terms. Those deals are usually private. So when someone confidently tells you exactly what every lounge earns per visitor, be skeptical. But the basic transaction is clear. Access has a cost, even when the person walking in doesn't see a charge. Here's why the math can work. What the visit feels worth to you can be much higher than what it costs the lounge to serve one more person. A traveler sees airport-priced food, a couple of drinks, Wi-Fi, workspace, and a quieter place to wait. The operator sees a controlled menu, bulk purchasing, shared space, and a seat that may serve several travelers during one day. Now, lounges are definitely not effortless money. Airport rent is brutal. Construction, staffing, cleaning, and food all add up. And once the room is full, one more guest isn't easy money. They're a problem. Still, when traffic is managed well, one space can collect revenue from several partners while delivering a benefit that feels expensive. And this is where the business gets much bigger. For a premium credit card company, the lounge doesn't just make money. It gives you a reason to pick that card and keep it. The bank can bundle lounge access with points, travel credits, hotel benefits, and insurance, then charge a substantial annual fee. And if you travel a lot, that pile of perks can feel like it's worth more than the fee. But wait, the bank is getting something too. It wants the annual fee. It wants the card to remain at the top of your wallet. And it wants a share of the economics created when you keep using that card for everyday purchases. That is why the lounge can be valuable even if a particular visit costs the bank money. The visit makes the card feel tangible. Points are numbers on a screen. A lounge is a warm meal, a quiet seat, and a door that opens when you present the right card. American Express, Chase, and Capital One have all attached lounge access to premium travel cards, and all three have invested in branded lounge experiences. The entire room becomes an advertisement you can sit inside, which is honestly pretty clever. It also attracts a particularly valuable audience, people who travel, spend, and may be willing to pay for convenience. So when a bank serves you a drink at the airport, it is not simply being generous. It is strengthening a customer relationship that may last for years. There is one obvious problem with making exclusivity widely available. Eventually, it stops feeling exclusive. As more premium cards added lounge access, travelers began arriving to find lines, waiting lists, and every good seat occupied. And that isn't just annoying, it threatens the whole promise. If customers pay a large annual fee, partly for a calm place to wait, a crowded lounge weakens the value of the card. So, operators and card issuers use rules to control demand. They can limit entry to a few hours before departure, restrict guests, charge for extra visitors, require minimum spending, or deny access when the room reaches capacity. American Express, for example, ties complimentary guest access at many Centurion lounges to a high annual spending threshold. Otherwise, guest fees apply. These rules can feel unfriendly, but they also reveal the hidden math. The business needs enough visitors to justify the lounge without allowing so many people inside that the experience collapses. The velvet rope never disappeared. It became an algorithm of card type, flight time, guest policy, spending, and capacity. So why do airport lounges exist? Originally, they helped airlines recognize and retain their most important passengers. Then, independent networks made access portable. Credit card companies turned it into a mass-market premium benefit. And lounge operators created a space that could be funded through several different doors. But if we only ask whether the buffet itself makes money, we miss the most interesting part of the story. The lounge can help sell a premium ticket, an annual membership, a high-fee credit card, more card spending, or years of loyalty. That's the real product, not free food, a change in what you do next. The traveler arrives early, chooses one card over another, renews for another year, or stays with an airline because the trip feels slightly less exhausting. And for the companies involved, those choices can be far more valuable than the drink in your hand. The next time a credit card opens a lounge door for free, remember, you are not outside the transaction. You are the customer, the audience, and part of the product. That's what was hiding past the fine print. If you like seeing how familiar businesses really make their money, subscribe. There's a lot more hiding in plain sight.